Good morning and welcome to your Financial and Power Hour. This is Jason Cryderman with Great Lakes Investment Advisors. I can't believe it. Here we are into fall, and it's amazing. If you're one of my viewers on YouTube, and of course if you're one of my listeners on the radio, you're going to hear some new voices on today's show. Now this is a temporary thing, so don't think I fired Tony. I didn't fire Tony out there, but today I actually have a co-host on my show with me, and then I also have two guests on my show. And one of the guests you guys, all my viewers and listeners, are going to be very familiar with. It's Mr. Keith Gangl from Gradient Investments. But we have a new portfolio manager that has recently joined the team within the last few months or so with Gradient Investments. So we're going to bring him on the show today as well. But before we get rolling, as most of my viewers and listeners are used to, when we start to show off, Tony and I kind of catch each other up on how things have been over the last, the weekend or the last week within our personal lives and our family. And so, Jaclyn, I kind of want to do that with you, and then we'll bring Keith in, and we'll also bring Kyle in to talk a little bit about themselves. And before we really get rolling into the show and start picking Kyle's brain today, I can't wait to hear all his expertise and knowledge. We also need him to give us a little background about who he is and kind of, Kyle, where you came from and your personal and professional life. But Jaclyn, let's kind of get right in. So again, I usually have Tony as my co-host. So Jaclyn, tell myself and my listeners and viewers, tell us a little more about yourself from a professional and a personal standpoint. Let's get caught up on who you are and what you do for Gradient.
Yeah. So, well, let's just start off by saying I am not a replacement for Tony. I will never fill those shoes.
Those are shoes impossible filling. I truly believe that.
Oh, completely agree. And I'm just not as funny as Tony. So I'm so sorry about that. I'm going to apologize right off the bat. But I am a media strategist and podcast co-host at Gradient. And so I get to do podcasts with people like you, Jason. And I am honored to be doing this with you and Keith and Kyle today. I mean, this is going to be a great show. And I've only been here for about a year, so it's kind of new to things. And yeah, that's about it. I did go to the state fair this weekend, though.
There you go.
The
That's
Minnesota
State
Fair. Yes.
Okay. So our fair here in Midland County, this was 2 weeks ago, and then this past week, all our kids started school. But tell us, I know, like ours was just the county fair. It's not as even, I don't even think a fraction of what yours is like. So tell me and my listeners a little more about what the heck is the state fair like for you guys over there in Minnesota.
It's crazy. I mean, they call it the Minnesota Get Together, right?
Okay.
And I stood in line for an hour and 45 minutes for donuts.
Oh my God.
But they
That's
are
commitment.
worth it.
Those better be some darn good donuts.
Yeah.
Yes, they're Amish donuts, glazed. I mean, I'm getting hungry just thinking about it, but definitely worth it. And just all sorts of fried food. Feel not so great today. But we're just gonna suffer through it because
so you got the week after fair hangover, and that's kind of what we call it here too, because we love getting the elephant ears, and we love getting the fries and vinegar, and you always the fair food is awesome, and you always overeat too much, and the big kielbasa with all the onions and stuff on, and then I feel for 2 or 3 days later I have a hangover from the fair, and I didn't even drink any alcohol. I just ate all the food there.
Yes. And thankfully I did not overeat. I mean, of course I overate. Let's redo that. But I mean,
Are you sure?
I wasn't uncomfortable, needing to go to the bathroom overate. So we're good.
Yeah.
It's overdrank.
Well, anyway.
So what all do you do at the fair? I mean, so your fair's like, it's got to be pretty darn big. And I mean, I envision our fair here in Midland. So we have like the midway where there's the carnival rides and the games, and then there's like a bunch of food vendors. And then the other end, we have all the 4-H animal barns and horse barns and exhibitor barns. And so my wife and I, we just try to do one night where we'll do barns. We'll do the horse barns, all the animals and the exhibits and that, a little bit of food. And then we'll take a night or two off. And then we'll do one night of midway with the kids for the rides. Because we just going 2, 3, 4 nights in a row at the fair is really not our thing. So what's it like for you guys? Is it kind of set up the same way over there?
Yeah, exactly. I mean, I love to go see the animals. That's probably the best part. They always have, fresh pigs, like just baby pigs, which is so fun. Or cows, or they breed there. So they're always born, typically the start of the fair.
Okay.
And you can even watch them being born, which is, I mean,
crazy.
a hit or miss for some people,
Yeah.
right?
That'd be interesting to be strolling by one of the corrals and watch a birth take place. That'd be quite an experience.
Yeah, it's super fun. And there's just, it's miles of fairgrounds. I mean, you're talking, I got 16,000 steps in just a few hours there. And that's also standing in line for an hour and 45 minutes. So
For those donuts, I know you told us all about it. For
yes,
the
yes.
It's got a big concert venue as well, right? If you want to, at nights and bands and.
Oh yeah, okay.
That's just kind of probably a bigger version of what you have. Kyle, do you know how many people? It's like a couple million. Is that what goes through in the?
It's the second largest fair in the U.S.
Yeah.
Is it really the Minnesota State Fair? Is that right? Wow.
In Texas.
Yeah. This year, I think they're angling for 2 to 3 million visitors just in 10 days.
Just put that in perspective. 10 days,
Wow, that's crazy.
A couple 100,000 a day. So Jaclyn, kind of, waded through the crowds and sat and listened.
Yeah. I mean, it's typical around here to take days off work to go to the fair.
Wow. I can only imagine being that big and that many people. You'd have to. I mean, it'd be really tough to just say, hey, we get out of work and let's grab the family and head down to the fair from 7 to 9 or something. I mean, you'd hardly have time to park the car, it sounds like, and walk in by that point.
Yes. You have to be very strategic about how you get there and who's driving and where you're parking, because it can be very expensive too.
Well, cool. Well, that's awesome. So it is fair season all across the U.S. And I know everybody here that's locally, my listeners and viewers, I mean, we had the Saginaw County Fair, and there's, of course, the Gladhill County Fair and the Midland County Fair up here. And I may have even seen some of you at the Midland County Fair. I was there just 2 different nights. We get quite involved as well in the 4-H auction. So for the last 3 or 4 years now, I get a lot of little 4-H children from Midland and Sanford area and Midland County, and they come to the office the week or 2 before the fair, and they drop off a lot of letters that they're raising these pigs or these cows or these turkeys, whatever it might be, and they're going to be auctioning them off. And it's been a really cool experience for the last 4 years. I've ended up buying at least 1 pig, and this year I purchased 2 pigs from 4-H kids and went in with a buddy of mine on a cow as well. So it's a pretty cool experience, and I love going there to support the kids and just to watch their faces when they're up there showing their pig, and people are out in the crowd and they're bidding on their pigs or their cows, and then when it sells, they get their picture taken. It's just a really cool, awesome experience that I've been really fortunate to get involved with in the last couple of years here. But hey, let's get right into the topics of the show. So we have Keith Gangl on the show, who's portfolio manager with Gradient Investments. We also have a new face, a new voice on our show today, and that's Kyle Bergacker. And Kyle Bergacker is also a portfolio manager. He's recently joined Gradient Investments. So let's start off, Kyle. I know a lot of my viewers and listeners are very familiar with Keith. They love it when he's on the show. And Kyle, just so you know, we will get phone calls and we will get emails after the show, probably for the next 2 weeks or a month or so, because people always listen to the show, not only when it airs, but also on any of the other venues that it's on, and then they see the YouTube channels. But they very well may call in and say, hey, Kyle said this, we got a question about it. Or I want to challenge Kyle. What does he think about this? Because I know when Tyler's been on the show, when Mike Binger's been on the show, when Keith's been on the show, when Jeremy would be on the show, our phones ring off the hook. We get a lot of phone calls. And so that's awesome. I greatly appreciate it. So, but before we dive right in, I know we're going to have a break coming up here, and Jaclyn's kind of going to control the show today like Tony usually does. But before we go to the first break, Kyle, can you maybe spend a few minutes, 2 minutes, 4 minutes, whatever it takes, and kind of go through who you are, personal life, as much as you'd like to share with us, your professional life, what you've done up until now, and now what you do with Gradient Investments.
Yeah. Well, thanks for having me on the show. Very much appreciate the opportunity. And great connecting. So my background, I've got a couple kids, married. I've got 2 boys, 6 and 8 years old.
Okay, cool.
Yep. So school is starting next week. My wife is a 1st grade teacher, so she's been doing that for, 15 years or so now.
Oh boy, so you'll have 3 of them in school.
Right, 3 in school, back to school. So everybody get back. We too were at the fair this weekend on Sunday, so it sounds like you were there yesterday, right, Jaclyn? Yeah. I too, I did not wait an hour and 40 minutes in line for donuts.
Donuts to you weren't worth it, huh?
Yeah, no, yeah. But yeah, so yeah, we love being outdoors and being active. We have a lake home in northern Minnesota, and so classic Minnesotans. We will go up on the weekends and we will hunt and fish and be outside and
Awesome.
do all that kind of good stuff. But my career, I started as a financial planner during the financial crisis during 2008.
Okay. Yeah.
Built a successful practice there, and I realized my calling was actually more on the analytics and portfolio building side. So in 2011, I sold my practice and started doing more equity-oriented research. So went to Columbia, which is under the Ameriprise banner, and did that for a couple of years, and then went to Oppenheimer Funds in Denver, Colorado, which is now Invesco. And once my wife and I had the kids entered the picture, we decided we wanted to be back in Minneapolis where our family is. And so we kind of picked up and came back. And so prior to this, I was at the Royal Bank of Canada doing portfolio management there, running domestic value money, so large cap value and a global equity strategy as well. So
Impressive.
So now I'm
That's
here.
very impressive. Yeah, that's very cool. That's an awesome resume. I mean, especially we go all the way back just to, the professional, but the personal life with your wife being a teacher and then having the two kids at 6 and 8. So my 3 kids are 18, 15, and 12. So I'm going to tell you this right now. Don't blink, man. Do not blink. And those of you, I mean, Keith, you're shaking your head saying yes. So last week we moved our oldest daughter, Lexi, into Michigan State, which God bless her. That's where mom and dad met. We love that. But I tell you what, that was one of the hardest days of our lives, was driving her down there, getting her moved in. That wasn't hard, but having to give her a hug and say goodbye. And then that hour and a half drive home, like Amy and I just felt so numb. So I'll tell you right now, man, the kids like that, it's so awesome, but don't blink, man. Take it all in. I love that you guys get up north to the house and you hunt and fish and do all that cool family stuff. And these are the best times of our lives as parents. And so this was our first experience taking Lexi to them, and she was like, oh my gosh, like she's growing up and moving on with her life, which is real exciting, awesome to see as well.
Yeah, that's awesome.
Mm-hmm.
Yeah, I dropped my last one off, the 18-year-old. So mine were 23, 21, and 18. So same thing. The first one, just so you know, Jason, give you a little advice. That was the hardest.
The first one was, okay, so I've heard mixed feelings on that. So if there's any of my listeners or viewers out there, if you've dropped your kids off at college, you've had multiple kids, so give me a call. Let the office know, because Keith says the first one was the hardest. I've heard mixed feelings, and we have some good friends that they just dropped off their third, and like one of them had 3 kids, dropped off their third. Another family had 4, dropped off their 4s, and they said that was the hardest, because now they're like, oh gosh, we truly are empty nesters. Now what do we do? So that's interesting to hear you say that, Keith.
Well,
tell me,
yeah,
how was the first one the hardest? You were just ready to kick the last one out, like just get out of here.
No. I mean, same thing, empty nester, that's going to stink for our family. We love, the chaos around the house having. So that is hard.
I will not tell your wife you said that, and I hope she doesn't listen to my radio show.
But on the first one, she went to Madison, so she was 4.5, 5 hours away in Madison, Wisconsin.
Oh, wow.
It was during COVID, so it was COVID, so restricted, right? So that was the hard part. You're dropping her off 5 hours away from home. It's COVID. You don't expect first year of college, or your first one is like, we did the same thing. We the rest of the other 2 younger siblings, we drove home, the 4 of us. Same thing. We drove for 2 hours. I don't think anybody said a word.
No, isn't that something?
Tears going down your face, and it's like, that's what I meant by harder. Now, for me, stepping back here, you wait probably 3 months. I'll say the last one was harder because now we're empty nesters, and it's like my wife and I and the dog at home, like looking at each other, like, well, now what?
Now what do we do?
So that's why I would say the barbell. The middle one wasn't as bad because you already went through the process. But no, it's definitely a sad time of the year for me, and everybody else is getting ramped up. I'm like, no more kids around the house.
Mm-hmm.
Yeah, no. So we're one less. We still got the 2, Carson and Josie, and they're both at Meridian, and they're both very active. Carson does football, and Josie's in the high school band as well as a high school cheerleader. So this really ramps up into our extremely busy season. And as a lot of my viewers and listeners know, and Keith, I think you know as well, I announce all the home JV football games on Thursday nights and all the home varsity games on Friday nights. So for our fall season now, we're getting really busy. We got our first football game, actually varsity football game, on Thursday this week because of Memorial Day weekend. And then Friday night, Michigan State plays Western at home. So we'll be loading up the car and heading down Friday morning to hang out with Lexi. She actually also made the cheer stunt team down at Michigan State. So it's just we have a whole craziness of excitement in our life right now, and we obviously take all the goods as best we can, but there's still that sadness there that baby girl went off to college, and that was tough. But well, hey, before we get into our first break, I just want to kind of let everybody know. So today's show is really going to be geared around market updates. So stock market updates. Not only do we have one of the masterminds and brains in the trenches today, we have two. We have both Keith and Kyle going to give us some insight on what's going on. Where have we been so far for the first 8 months of this year? Here we are in August. What has happened in interest rates and markets and different sectors of the economy? Goods and bads. I mean, there's the T word of tariffs. There's just been a lot going on out there, right? A lot of noise. We've talked about it on the show before. And then it's the reality of what's really happening in the markets and the trenches and what's happening with money. And then we'll talk about, where do Keith and Kyle see the markets going for the second, I guess the fourth quarter here, last part of the second half of the year into the winter months and then into next year. And they'll tell us a little bit of insight about what does Gradient Investments think and what is Gradient Investments doing with money in their portfolios based on interest rates and markets and tariffs and all this other stuff. So I guess, Jaclyn, it's probably time to take us into a quick break, and we'll be right back.
All right. So you are listening to your Financial Empower Hour with Jason Cryderman. And we were just getting into the discussion here about, market updates. And where do we want to take it from here, Jason?
Well, I mean, there's a lot of stuff out there, right? And I always tell my viewers and my listeners, be careful what you listen to and where you get your information from. Do your own due diligence. It's awesome to be educated, but be very careful where that information is coming from. Consider the sources, check the sources, and look multiple areas, right? It's just like your health. Get a second opinion. So if you hear something out there, don't freak out and panic right away, because there's a lot of noise. There's a lot of just, garbage out there, so to speak. But when you have an opportunity to pick the brains of portfolio managers, and I can tell, Keith and Kyle, they're in the trenches every day of the week. Their professional jobs are to worry about what the heck's going on with interest rates and with stock markets and large cap and small cap and international, and what type of play do tariffs have. So I got a couple questions that I kind of want to throw out there first to Keith and Kyle, and I'll let you guys kind of go back and forth a little bit and bring us up to speed on what's going on. And then I want you guys to feel free to throw in any other, information you think is very important right now in our markets and our economy. And Jaclyn, feel free to chime in and ask your questions or throw comments out there as well. But I know last Friday was a very important day. We'll talk about Fed, Jackson Hole, the annual economic symposium. And Chairman Powell signals a path to rate cuts. Why is that important? I know this is a question I've had from a lot of my clients, is if they cut rates, how does that going to impact stocks, bonds, and then fixed investments, like CDs? And if they don't cut rates, what will happen if they stay the same? And what happens if they actually raise rates, which some people have been talking about as well? So let's start there, you guys, with kind of the Feds and what they said, what they did, and what we think might happen for the rest of the year, and the overall impact that has on people's money.
Yeah, I'll start out, and Kyle can add a little more details on it. Yeah, last Friday was a big event, Jackson Hole. It's the last Fed, Powell's update. He's done 8 of them. Basically sets a tone for where interest rate policy is going. And basically what came out of the meeting is the fact that now he was kind of hawkish. That means he's more in the camp of kind of keeping rates where they were or raising them prior to this meeting. So Fed funds rate, why that's important, because when they cut the Fed funds rate, that basically stimulates the economy. Now there's a balancing act, right? The Fed's got two mandates. It's full employment, which we're at about 4.2% unemployment rate, which is very healthy, but we're starting to see some softening in some of the data, so a little worrisome. The other thing is where they watch inflation. The Fed's target is 2% inflation rate. Right now we're above that, around that 2.7. And with all the stimulus, the tariffs, we don't know the full impact of tariffs. Chairman Powell is more in the camp of, well, these tariffs could be inflationary, so we can't be lowering rates in front of inflation if that's going to tick up. We don't want to do that, and that's kind of what we had. If you go back to 2022, right, when inflation went to that 9.1%, that was a disaster for the overall economy, bad for the stock market, certainly bad for consumers, right? When you went to the store and you're paying 9-10% more than you were than the year before. So that's why now if the Fed starts cutting interest rates, that stimulus to the economy, which generally stock guys like that, right? More economic activity, stocks generally do well. And that's why you saw the markets actually on last Friday, we were up, over 1.5%. Again, the fact that Powell is basically indicating that they have a meeting next month. Instead of being no cut, they'll probably start the cutting cycle again. And again, that's going to be stimulative to the overall markets and the bonds, right? When you cut rates, bond prices go up. So that's kind of good for the bonds, just like it was a few years ago, right? When rates were going up, when the Fed's raising rates, bond prices were actually down. Remember that year we actually had bond prices down, the stock market was down 20%, bonds were down 13%. So we're on the other side. The Fed starts cutting. That should be a tailwind for the overall stock market and the economy, and it should be good for bonds. Now, the one area that's probably not that great for is short-term investments and kind of retirees, right? That CDs in the bank, things like that. Now, that's directly tied to the Fed funds rate. So if they start cutting, that would actually be a little bit of a negative or less opportunity for them to make money. So you got any thoughts on that, Kyle, as well?
Yeah, no, I think you hit the nail on the head. I think now it's a balancing act for sure for the Fed. With the two mandates that they've had, I think they've introduced a little bit of flexibility into it based off the comments from last week, where they now are looking at more wholesome data points around labor and what kind of how a little more squishy it is, and incorporating more broad terms around the inflation data. So I think that opens the door for them to provide a little bit more liquidity into the market, which cuts both ways, right? So if inflation does kick back up a little bit, that's going to be a bad thing. So I think they're taking a cautious tone, but
Sure.
The markets liked it for sure. And some of the rate sensitive areas, you think about with small cap names, a lot of investors have that in their portfolios. It's not all S&P 500 names, right? So within that S&P 500 group, there's a lot of smaller cap names. It's not all about the NVIDIAs and the Microsofts out there. And we saw on Friday, small cap was leading the rally. They were up over 3% for the Russell 2000 index, which is that small cap basket. So I think, providing some tailwinds is needed in some of the pockets of the economy. And I think that's going to be helpful going forward.
It's good for interest rate sensitive kind of stocks and areas like you can think of home builders, things like that. Those are, different areas that could potentially do well when you cut rates. Right now we've talked in the past, Jason, about, the tight housing market, and it's just how it is. And it's with rates high at 7% 30-year mortgage. That's tough to get a mortgage. You're kind of locked in. Now, if rates start coming down, that 30 years should follow that to some extent, not exactly one for one move, but that should spur some economic activity. People can maybe move that were kind of house locked and things like that, which is generally good for the economy.
So you're giving me hope so I can buy a house
We
eventually?
are a little silver lining, not too much, but a little bit.
So from an old Adam Sandler movie that my son Carson's a big fan of, so you're saying there's a chance.
There's a chance.
So you're saying there's a chance.
No, I don't think they're going into 3% anytime soon. Kind of where, if you have been around for a while, Jason and I, it's like if, fortunately, you back it up a few years ago, people were getting those 30-year mortgages for a little above 3. Now we're at 7.
The reality of that is we've talked a lot about interest rates on the previous shows. This show might go all the way through with interest. We could definitely do a whole show just on interest rates, because if you think about it, interest rates are truly a double, even a triple-edged sword. Because as you guys, Keith and Kyle, just talked about, when interest rates go down, which could be a good thing for the market because bonds would go up, that's a positive thing, and stocks could get stimulus, that's a positive thing. But mortgage rates might go down. So when we're borrowing money, that could be a positive thing. But what about when we put money in CDs or short-term and all of a sudden those rates go down? It's like, well, wait a minute, I want to make more money in my investments, not less. So it really is an interesting, I guess, overall mix. And that's why Keith and Kyle, as you know, I really try to do a tremendous job for my clients in diversifying. Do not put all our eggs in one basket. It's not all stocks or equities. It's not all, like you say, Kyle, S&P or small. It's not all bonds. It's not all CDs. It's not all fixed annuities. We have to have a very good blended, diversified portfolio. And the tagline of my book is called Plan for the Best, Prepare for the Worst. And I truly believe in building plans and portfolio management to plan for the best, that everything's going to be great, but we have to be prepared for the worst, whether that be interest rates spiking, inflation spiking, interest rates down, bonds down, stock, whatever that might be. We're going to build a portfolio and a plan that's designed to weather those storms to help smooth out the ride into and through a successful retirement.
Yeah, Jason, I think let's take a quick break. But can you tell our listeners and our viewers how to get a hold of you for that no obligation consultation?
Yeah, so I always offer, a no obligation consultation to talk about what you're currently doing and do what I call a second opinion portfolio stress test. It's really like an MRI or an X-ray on your current portfolio. Just kind of identifies areas of opportunity, maybe some potential problem areas, and we can help give you some ideas and thoughts on that. Or again, if you have questions about today's show or other questions for Keith or Kyle today, please, by all means, give us a call here in Midland at 989-835-7203. Again, that number is 989-835-7203.
Thank you, Jason. We will be right back. All right, we are back with your Financial Empower Hour with many guests today. I'm one, being Jaclyn, but we also have Keith and Kyle here. So where were we in this discussion with interest rates and the market updates?
Yeah, so I think that last segment right there talking about interest rates and the Feds and that Jackson Hole meeting they had. Now I do want to make sure I tell people when we talk about last Friday or last week when they made the decision and the markets kind of rallied a little bit. Remember, I recorded this show on Monday. So last Friday, when you listen or see this show on a Sunday when it airs, it's actually 2 Fridays ago. So some people might be thinking, wait a minute, and I just kind of like to try to remind my viewers and listeners of that. But most of you follow right along, unless you're a first-time viewer or listener. If you are, well, thank you. And I look forward to talking to you a lot more throughout the rest of the year. But we started off that last segment talking about the Fed's decision. Before last Friday, they kind of talked about, well, we might raise interest rates. And then all of a sudden they said, well, we're going to kind of hold. And then they kind of hinted at, well, we might lower them. So there's a lot of uncertainty unknown out there. And again, that's why I think it's very important to entrust in a team like Grady Investments and like their portfolio managers, Keith and Kyle, who are guests on my show today, to talk about, what if they do raise interest rates? Then what do portfolio managers in the trenches expect will happen? And what are they prepared to do? And what if they go the opposite direction and they lower interest rates? What are portfolio managers in the trenches thinking might happen, and what are they prepared to do with portfolios at that point? So, guys, maybe give us a little bit of insight there that if rates raise, what you think might happen in the market and portfolios, and if rates fall. And then I want to kind of get into maybe second quarter earnings. We want to talk a little bit about the tariff impact, what that's done so far, and what that might look like as well.
Yeah, I'll start out again, and Kyle can add on to it. If they raise, I think that would, at this point in time, would surprise the market. And generally, markets don't like surprises. So if it does surprise the market, I think for whatever reason, I think it would be a negative reaction by the overall stock market. I think the markets would sell off because right now we're into, like you set it up well. It was the possible raise a while ago. Then it was nothing going to happen. Now we're in the camp of the probability. If you the odds right now are around 80-85% that we see a cut in September. So if that doesn't happen, unless they have some language around the forward guidance, I think the markets would kind of say, okay, you're expecting a cut. And the reason we like a cut, we just talked about the previous segment, it's good for the housing, good for the, stimulate the overall economy. Maybe, not so good for some of the savers, but that would be a surprise to the market. I think they would negatively react. So I think that's what would happen now at some point in time, the market, had this nice little rise, like you said, on the other week on Friday because of what you said. If they do go ahead and cut, at some point in time, it'll be priced in by the market, and then it's all a matter of what, company fundamentals. And then we get into Q3, earnings reports, which will be in October timeframe, right? You and I will have this conversation, and probably
absolutely,
we'll debate what should we do as portfolio managers. We're under the assumption right now there'll be probably 2 cuts, maybe 3 cuts this year. So if they do that, we kind of have to change some of our portfolio. Kyle, one of the portfolios he manages, that kind of some of the interest rate sensitive stocks that have performed really well the last couple of weeks due to the fact that the changes that we think that the Fed's actually going to cut. So those are some of the things that we do as active portfolio managers, and we do a great job working with you as well. It's like, okay, you said don't put all your eggs in one basket. We these clients, whether we're right or wrong about interest rates, they have to be diversified, and whether it's, the different things that you sell, the services you provide them. So that's important as well.
Yeah, I think that's right on the mark. One thing that I think is really important is understanding what your bets are. And that goes for clients as well as portfolio managers as well, right? It's not just a single equities or fixed income or anything, your portfolio is diversified, whether it be short-term, midterm, long-term money, what kind of vehicle it's in. So understanding where the bets are and the pros and cons of each really matter. And so one, as Keith was just outlining, one of the strategies I run is a contrarian portfolio. So taking kind of deep out of favor bets. And one of those, bets has been housing and asset sensitive banks. So you think about exactly what you're talking about, Jason. With the if the rates drop, you're going to have short-term impacts on the interest rate you're getting on your CDs and in your bank and your money markets and that kind of thing. So understanding where those risks in a portfolio are, and if it were to cut the other way and have a negative surprise, not being over your skis with too much risk. So being able to balance the risk and reward in an appropriate way, and just having a prudent mindset, I think is the target.
Yeah, I think that's great feedback. And you I like what you said right there, Kyle, when you talked about if, interest rates are going to potentially go down. Keith, you mentioned it too. You guys are already positioning in the portfolio those interest rate sensitive sectors or regions or even companies, right? We talk about a stock company or an ETF or something. You're already looking to say, gee, if they are going to go down, which most people anticipate, over an 80% chance, the reality is they're probably going to cut at least 1 to 3 times. So being proactive and trying to get ahead of the curve, I think, is also one of probably the biggest benefits that my clients have received, you guys, from having their money in gradient portfolios, is how proactive and ahead of the game you guys always try to be. And I will say 9.5 to 9.75 times out of 10, it pans out absolutely perfect. And being ahead of that curve just a little bit, right? What we don't like to see is, and that's called active management, by the way, for my viewers and my listeners, that's more active portfolio management. Sometimes what's lagging is when we see passive management. And those are really just different types of managers or philosophies that they kind of wait and see how things pan out, and then they react after the fact. And not that that's not bad, but when you look historically over time, generally active management can perform a little better to maybe take advantage of some of those upsides or even protect a little from more of the downside. So the philosophy you guys have behind the scenes, I love that you guys will share that like this on my show today, because I mean, the numbers speak for themselves in your portfolios. And so to hear it from you guys of, that's why they're doing what they're doing, totally makes sense to me. So thanks again, guys, for being part of the show and sharing that with us. Let's move on a little bit from interest rates, if we could. Let's get into maybe some of the, earnings are coming up here, but let's get into more of the tariff talk. And let's talk about, when President Trump first said tariffs, I think a lot of people thought, oh my gosh, the world's going to come to an end. The market corrected itself very quickly, very sharply. And then the smoke started to settle, so to speak, and negotiations were taking place. And I think we've had a really good run up in the market since then. So tell us where you guys think that the impact of tariffs had immediately, and where you think we are today, and where we might go in the future.
Yeah, I'll start out again. And then, April 2nd was Liberation Day, the first day those tariffs were announced. And I always kiddingly say, everybody, it was Liberation Day for everybody's wallet got liberated because the markets right?
Quickly, it happened quick, right? It just happened so fast and pretty drastic. And thank goodness there was a bottom quickly there. Yeah,
it was, a matter of, a few weeks, and the markets are almost down 20% because, again, to our point we made earlier, is investors don't like uncertainty, and
correct.
By introducing tariffs that introduced uncertainty, and investors didn't know what to make of it. And then you had a lot of people saying, oh, that's economic chaos. We don't know what to do with this. Sell it off. Or you could have been in the camp of the art of the deal. Those are the kind of two of the camps, Trump's art of the deal, the book you wrote. That's what we were firmly into that camp. We didn't know what kind of deals were going to be shaken out. And I think that's what the market's kind of come around to. It's going to be art of a deal. There'll be some concessions. There'll be some revenue raise. The one thing that surprises me so far is they're pretty aggressive, these tariffs that he introduced on April 2nd. They went a lot higher, and he's scaling them back, but there's still going to be that effective tariff rate. Just so you know, it went from like 2.5%, 100 years ago was about 20%. And then for the last 100 years, it's gone from basically, that 20% down to 2.5%, stayed like that for, decades. And now with this latest stuff, we're going to jump it back to 15%-ish roughly. If that means there's going to be a tariff or tax on somebody, whether it's the person selling the goods in a foreign country, the person buying it, selling it in our country, or the end consumer. It'll be a combination of all three, just so you know that. And you hear from a lot of media people, one of the things that they're kind of fear mongering was that 100% was going to be paid by the consumer. That's not going to be the case. It'll be some piece of that just to understand that. So that's kind of what we like to tell everybody. But again, so the tariffs are in place, but the amount of revenue those tariffs are raising, it could be, really important. I mean, that when it was at 2.5 effective tariff rate, it was raising about 1.6% of our overall revenue tax budget. Not much, but with this latest stuff, if they stay, it's going to be above 10%. Hopefully that could maybe bend this, I don't want to get in a debt discussion, all that stuff like that. That could maybe bend that curve eventually. And that could be a good thing. I read this morning, it's like, there was a CBO report that came out, said it could take off $4 trillion off, our budget by 2035, which you don't hear that, right? It's always adding to the budget.
I don't know how that can't be a good thing, right? I mean, if that really truly plays out, then I don't understand how that can't really be a good thing overall for the United States and for our debt problem that we have.
Yeah. You got any thoughts on it, Kyle?
Yeah. I mean, I think the percentage of newfound revenue is in line with what the current corporate tax collection is. So if you think about that newfound revenue, it's almost like the analogy of going on an airplane, right? Like unbundling services. So you used to be able to fly on the planes, and you could, bring your carry-on and pick your seat, and it was free. And now they found these new revenue sources of you got to pay for this seat, and you have to pay for your carry-on, and this and this and this. And it's like tariffs are kind of the same idea, where
absolutely
it's free, and now that's a new service to generate revenue. And I think it's going to be really tough for them to kind of put that genie back in the box. And we saw that during the first tariff kind of tantrum in 2019, where Trump came on, put some tariffs on, and during the Biden administration, they did not take them off. They actually added to them. So I think the genie's out of the bottle, and if it does bend the curve of debt, that is not a bad outcome in my mind.
No, I agree. I totally agree. And it's interesting, as you mentioned there, like there was the original tariff tantrum in 2019 of Trump's first administration, and then the Biden administration didn't take. So if it was really a bad thing, I think they would correct those things, right? So they even added to them a little bit. Now, obviously, a lot of people would agree that when, come April 2nd this year, it was fast. It was fast. It was drastic. It was hard. It was like, oh my gosh. But things have settled down since then. As you mentioned, Keith, the negotiations, the reductions, the smooth out. I think the approach maybe was not the best, so to speak, but the overall plan sure does seem to be that added found money, like you mentioned, this newfound revenue source, really could be a very positive thing, not only for the U.S., but maybe we could touch on in the next segment, because I think we got to take a break for a minute here, but we could look at the international markets. I mean, I've been kind of, I'm not in the trenches like you guys, but I think a lot of these tariffs have even been or could be a very positive thing for international markets across the globe as well.
Yeah. All right. Well, we're going to take our final break here. We will be right back with your Financial Empower Hour. All right. We are back and better than ever, right? All right, Jason. Well, we just have a quick 5 minutes here to add on to our discussion. So where should we start again with the tariffs? I know that's what we were discussing. Is there anything else that we want to add about tariffs?
Well, I think what I'd really like, I love doing this at the end of the show. And now that I have both of you on here, Kyle and Keith, this is even going to be better. Okay. And I don't want you guys to piggyback off each other unless you absolutely have to. So think about that. And Keith, you've been going first all show today. So I'm going to let Kyle go first. Okay? I'm going to let him go, and I'm going to kind of pin you back there. Okay. So you got to let the new guy have a chance, right? I'm going to put him in the front stage and let you sit back from him. But a lot of times how I like to end these shows is say, okay, everything we talked about on the show today, Kyle, things you thought we were going to talk about, things that you wanted to talk about and we didn't. I want to give you a minute and a half right now to tell us, kind of sum up the show, talk about 1 or 2 points that you thought we'd talk about or you think are important to share with my viewers and my listeners, and then give your kind of 30-second, okay, now what, moving into the fourth quarter of this year. And the clock's starting now. Go ahead, Kyle. Let's hear what you got to think.
All right. Well, I think we've got the Fed making waves, and they are center stage right now. So that is making the headlines and will continue to do so, right? People are excited. There's been money on the sidelines. People are looking to buy homes. Wink, wink.
There you go, Jaclyn.
people are hungry. So I think that is going to be a theme that continues to resonate with people. And then additionally, on the other side, it would be people looking into retirement and saying, hey, I'm fearful that the rates are going to go down because I generate that current income. And what do I do? And I think the key takeaway is effectively to bring an umbrella, because there's going to be continued volatility, upside and downside. Volatility is not always a negative thing. It can surprise to the upside, which we saw on Friday in stock markets. And so I think it's just continuing to be aware, be diversified, look for financial expertise, and don't put all your eggs in one basket. I think that's the takeaway for me for the conversation today. In terms of fourth quarter and what to look for through the rest of the year, it's continue to bring that umbrella, and then make sure that you're aware of your what risk bets you're actually taking. So everything shouldn't be just in NVIDIA. You shouldn't be, you should be international. You should have some fixed income. You have a wide, prudent basket of investable assets, and have somebody to be able to talk to that can help weed through and dampen some of the high emotions that you see in the media. That's really what it is. People who just read the news on the online or in the paper, get that one kind of food source, it can create problems. So,
or better yet, Facebook or social media nowadays, right? And that's why I started the show by saying, be careful what you listen to. Get educated. Don't just now. So I'm going to sum up what you said right there. Be aware, be prepared, be diversified. I love it. Now, Keith, don't you find it interesting? He used a term that we had a show back in January or February where you were on my show, Bring an Umbrella. That's how we started the year out, Kyle. It's amazing you said that, because we actually had a show that was called Bring Your Umbrella. We don't mean it's going to storm, but be aware and be prepared. So here we are 8-9 months later, we're talking about the same things. And so it's just, markets are cyclical. Things happen for a reason, but we don't change either. How you manage money and how I build portfolios and help families is be aware, be prepared, plan for the best, but prepare for the worst. Bring your sunscreen, but have the umbrella ready. I love it. So Keith, real quick, I know we only got a minute or two left. Keith, give us your final shots.
Yeah, I can see why you let Kyle go first. He just nailed it between you two. I don't have a whole lot to add to it. I mean, you guys exactly said what you want to do is stay diversified, be aware of what's going on. Working with you has been fantastic. You do a great job for your clients. I can't emphasize that enough. I mean, they're all diversified. They're not all just chasing performance. You have different reasons that you have them allocated different portfolios for, whether it's safety, whether it's growth, things like that. So 100%, you've been doing a fantastic job. Now, again, we'll do the same thing on our portfolio side. We'll stay diversified. We'll look for the opportunities Kyle laid out, kind of where we're looking at. I think, if we want to look at our forecast, I think the market continues to grind higher. A lot of things that we just talked about, earnings, you got this rates potentially coming down. You got this tariffs, which at first was bad. Maybe at the end of the day, it could be okay to good. So I think that could be a potential catalyst as well. But again, markets had a nice move where we've had two fantastic years that, in 23 and 24. So 25 is, we're up. When I say market, I'm referring to the S&P 500, around 10%-ish. So that's a very strong average year. So it's, again, I think, but the market fundamentals are still in place.
Yeah, you said that perfectly, Keith, and both of you, thank you for being on the show today. And Jason, thank you for having me on the show today. It was such a blast, and I learned a lot from all of three of you. And can you just tell our listeners before we go how they can get a hold of you?
Absolutely. So again, hey, Keith, Kyle, thanks again for being on the show. Kyle, thanks for sharing, a little bit more about your personal life and professional life. Now that you're on the team at Gradient, my viewers and my listeners, you're going to see and hear a lot more from Kyle. Matter of fact, due to his answer, you're probably going to hear more from Kyle than Keith. But Keith, we're not holding anything again. So, and Jaclyn, thank you so much for stepping up when Tony couldn't be here. And viewers and listeners, who knows, we might even see a little more of Jaclyn than we do Tony. So I wouldn't be opposed to that. Don't tell Tony I said that. But so anyhow, listeners and viewers, if you have any questions about today's show, anything we talked about, if there's any topics you'd like us to talk about in the future, or you'd like to schedule that no-cost obligation for a portfolio stress test, just a quick little MRI or X-ray on what you're currently doing today, please give us a call at the office at 989-835-7203. Again, that number here in Midland is 989-835-7203.
Thank you, Jason. That does it for your Financial Empower Hour with Jason Cryderman.